This is Ralph Sass, and this is the second part of the lecture for Chapter 10 on liabilities, and we're beginning with bonds payable. Bonds are typically issued by large companies and where they're borrowing a large sum of money. That large sum of money is called a principal. Whoops. It's usually paid back in a lump sum. So unlike an installment loan where we left off on the last chapter where you're paying off $1,000 a month, whatever, usually what big companies do is they'll borrow $10 million or $100 million, whatever, and they say, we'll pay you back in 30 years. And what they often do is they'll pay you back in 30 years, but they will pay you interest typically every 6 months between now and then. Bonds are often issued at what we call par value or face value. Typically that amounts to $1,000. I have seen it at $5,000 and or $10,000. So there are some bonds that are issued at amounts other than a face value or par value of $1,000, but usually it's $1,000. They usually carry some sort of a stated rate of interest. It's usually written in the bond payment, so it's not a variable interest rate. It's typically, as I mentioned, paid semi-annually. So usually the way the interest is calculated is we're going to take the rate, or pardon me, we're going to take the principal, multiply it by the rate, whatever that contract rate is, and multiply it by time. Usually that time is going to be 6/12 or 1/2 of a year. Sometimes we're going to have to do perhaps adjusting entries where it might be like 3/12 or 2/12. But for the most part, it's going to be to figure out the interest rate between the periods. It's going to be 6/12 or a half a year. They're typically issued through an underwriter. Okay. You can usually buy them on the New York Stock Exchange. You can buy bonds on the New York Stock Exchange. Usually stocks like GM, or pardon me, bonds like GM, what have you, are sold on the New York Stock Exchange. So that's where they're sold. And they're quoted as a percentage of par. Okay. So for example, the way to interpret, if you saw a price of 102, the way to interpret that is it's 102% of par. So you'd take 1.02, multiply it by 1,000, and the price of the bond would be 1,020. If the price of the bond was 90, that would mean that it is selling at 90% of par, and you'd take 1,000 times 0.9, and it'd be selling for $900. There are a lot of different types of bonds. A couple that I want to talk about just briefly are mortgage bonds are usually issued to buy a building or what have you. Convertible bonds are convertible into stock. And the reason why a company would issue convertible bonds is because they really, and I hate to say this, don't want to pay you back. And so what they're hoping is that the price of the stock goes up enough that what you'll do is take that bond and turn it into stock. For you and I as investors, it also has some nice features in that they're going to pay us an interest rate, maybe 4 or 5% or 2-3%, whatever that number is, for a while. And if the stock goes up, we're going to be able to benefit from that because we'll be able to turn our bond into stock. And if the stock doesn't go up, if the company doesn't do well, we still owe that bond, we're still going to earn our 2 or 3%. And theoretically, if the stock doesn't go up at all or the company doesn't do anything over the next 10 years or whatever that period of time is, I'm going to get paid back my original amount. So it's a way to guarantee myself kind of a floor. I'm going to make 2-3%. In the event of bankruptcy, I'm pretty high on the payment chain, so I'm probably going to get most of or all of my money back because it's a secure, usually it's some sort of a secured debt, or it's at least high enough in the security scheme that I'm going to get some money back. And if the stock does really well or the company does real well, I'll be able to profit and benefit from that as well. Junk bonds are bonds that are low, have low credit ratings, and are relatively speaking unsecure, although they usually pay a higher interest rate. And for the most part, companies have done, or investors have done okay buying those. Okay, so those are the major types of bonds. When we account for a bond, okay, they issued this bond on March 1st. Notice interest is payable on March 1st and September 1st, and they're issued at face. Notice in this case, cash goes up by $1 million and bonds payable goes up by $1 million. Okay, it is unlikely and unusual for bonds to be issued on March 1st and have interest payable on March 1st, what have you. usually there is some accrued interest that we need to account for. Notice what happens here on September 1st when we that first interest payment. We have $1 million of bonds. The stated rate is 6%. It's for half a year, so the interest is 30 grand. So the bond interest expense is 30 grand, and cash that's going out in this case is 30 grand. We've seen that journal entry or a version of that entry in the past. Notice on December 31st, we only have interest now for 4 months. We have it for September, October, November, and December. So that's 4 months. So this is the adjusting entry at year end to account for this. We take the million, multiply it by the 6%, which is the rate for 4/12, and we have interest expense, interest payable, and that's just like the adjusting entries we saw back in chapter 4. Then in March, when we need to make that interest payment of 30 grand, notice the interest expense is for 10 grand, 1 million at 6% times 2/12, and the bond interest payable is 1 million, or pardon me, the 20 grand that we had in that prior journal entry in our adjusting entry at the end of the year. 99% of the time, bonds are issued between interest dates, okay? And so the selling price of the bond is computed as follows. The present value of the bond, add to that the accrued interest since the last payment, and that'll give the selling price of the bond. The reason why this occurs is, suppose, let's go back to that prior bond, and the bond was issued on March 1st and it pays interest on March 1st and September 1st. If I sold it to you on August 29th, would it be fair for me to sell you a bond on August 29th, knowing you get the full interest for all 6 months on September 1st, the next day, for the $1 million or for the amount that you invested? And the answer is no. You only owned it for 1 day. It's not fair for you to get the interest for 6 months. So when we account for that, or when we sell bonds between issue dates, we have to account for that. So notice what we're going to do here. They issued $1 million of 6% bonds at par on May 1st, 2 months after the March interest date printed on the bonds. Okay, so notice what's going to happen. They're going to collect cash not of $1 million in this case, but 1,010 grand. Why? Because they're going to have the bond interest payable of $1 million and then the bond interest payable of 10 grand. You're going to have to pay them 10 grand, okay, because in 4 months, they're going to pay you 30 grand, because they can't, when it says that they're going to pay you 6% on that $1 million, they have to pay that 6%. So what you're going to do is take $1 million at 6% for 2/12 of the year, and your bond interest payable will be 10 grand. Okay. Then notice what happens on September 1st when they owe you the interest. The cash that's going to go out is 30. The bond interest payable will be 10 grand, and the bond interest expense will be 20 grand. So you will have earned interest for the 4 months that you owned it, but you will not have earned interest for the 2 months that you didn't. So you're paying the 10 grand to them up front, and in 4 months they're paying you back the 30 grand, which is 10 grand of your own money plus 20 grand for the interest. And that ensures that you earned interest only for the actual amount of time you owned the bond, and it makes sure that the company only pays interest for the amount of time that they actually borrowed the money. Bonds can be issued at a discount or a premium if they are sold at above the par price. If they're sold for more than 100, they're at a premium. If they're sold at less than par, they're sold at a discount. Okay. The reason why this occurs, and we talk about this in economics, when interest rates go up, the value of a bond goes down. So, and when interest rates go down, the value of a bond goes up. And because of that, bonds are often sold at rates or at either premiums or discounts. In fact, it's almost, unless you buy it at when it's initially offered, it's almost always, bonds are almost always sold at either a premium or a discount to their par value. So notice what happened in this particular case. They issued bonds on March 1st. The principal is $1 million. The issue price is $970. The stated interest rate is 6%. What that means is that the interest rates have gone up since they originally put this bond, or since they set that rate at 6%. Interest rates have gone up, so they have to sell it at a little bit less so that investors can earn whatever that current market rate is. So what they're selling, what's happening in this case is they're selling this bond at a $30,000 discount. So when we do our journal entry for this bond, what's going to happen is we're still going to have bonds payable of $1 million, but we only collected cash for 970 grand. So that other 30 grand is going to be a discount on the bond payable. And what we're going to do is to amortize that over its useful life. So since its useful life is 20 years, because we borrowed the money for 20 years, okay, we're going to take $1,500 per year, or $750 every 6 months, and amortize that. How it's going to show up on the balance sheet is it's going to show up on the balance sheet as bonds payable, less discount on bonds payable. So it's going to be on our balance sheet for 970 grand, and we call that the carrying value of the bond. Okay, now we are going to amortize that, as I already mentioned. It's going to be $750 every 6 months. Okay, why? Because there's 40 periods, and so it's going to be $750 every 6 months. So every 6 months, when we do the journal entry, notice we're going to have $30,000 in interest expense. Pardon me, $30,000 in cash that's going to go out. That's my credit. My debit is the interest expense, which is $30,750. And notice my discounts on bonds payable is going to be a credit for $750. So what's going to happen? Okay, when they pay the bond, let's see if I don't have it here. What in essence is going to happen, and I'm going to skip back one slide, sorry for this, is that, up 2 slides, is that every 6 months, that 30,000 there is going to get $750 smaller. Since that 30 grand is going to get $750 smaller, that carrying value is going to go up by $750 every 6 months. And what's going to happen is, since it's going up $750 every 6 months, at maturity date, the bonds payable is going to be worth a full $1 million. We're going to write them a check for $1 million, and that's going to be my credit, and that'll be my journal entry in 20 years when I go ahead and pay off that bond. Present value and future value are important concepts for accounting and finance, and I'm not going to spend a lot of time on them today, but we do talk about them in Business Math 2, and we talk about them in a finance class, and there are a lot of tables and what have you that are available so you can calculate those particular numbers. Okay, when bonds are issued at a premium, the borrower repays less than the original received at the date. Okay, and in this case, it's going to be exactly the opposite from what we were doing with the discount earlier. So instead of being, instead of $750 more, in this case, if it was a $20 bond, it would have been $750 less every 6 months. There's also the concept of present value and annuities, and once again, I'm not going to spend any time talking about them in this class, but we do talk about them in other classes. When bonds are paid off, they can be retired early by doing one of 2 things. Okay, you can either exercise a call provision. Most bonds do have some sort of a call provision which says if we want, we can get this bond back early, and usually you have to pay more than par value. The usual amount is 102. So what the company says is, if we're going to buy this bond back early, we have to pay you 102% of par. Okay. And it is one of the ways that companies do buy back their bonds. The reason why they often have to buy them back at what we call a premium at 102% of par is because the reason why a company would want to buy the bond back is because interest rates have gone down. And because interest rates have gone down, that means you're not going to, as an investor, it's going to be harder for you to find another bond to replace that because interest rates have gone down. So they've got to pay you a little bit of a premium over at least the par value to reflect the fact that it's going to be harder for you to replace that particular bond. The other way they can do it is to purchase the bonds in the open market, and they do that instead of doing the call provision, depending upon the various prices involved, what have you. Okay, and gains or losses from retiring bonds are reported on the income statement. Already mentioned this, okay, but you do need to accrue for a loss contingency if you can, if there is some event that has occurred and if it can be reasonably estimated. And I had this on one of the very first slides in this chapter. In the event something occurs and you have a loss and you can estimate the value, you do need to put it on the balance sheet. So let's suppose I have just recalled 2 million cars and I know the cost to repair each car is going to be $100. Do I have to take that 2 million cars, multiply it times $100 and put that liability on my balance sheet? The answer is yes. Okay. If there's a fault in the car, but I don't think I'm going to have to recall it, I have no idea how much it's going to cost. Is it going to show up on my balance sheet in that particular case as a liability? And the answer is no. So the question is, hey, do I know there's an event and can I reasonably estimate the value? If the answer to those questions is yes, I do have to put that liability on my balance sheet. One of the ways a ratio we use is what we call the interest coverage ratio, and it's operating income divided by interest expense. And it gives creditors an idea, it gives the people that have lent you money an idea of how safe their investment is, okay? From your perspective as someone that's lending the money, the bigger the number, the better, because that means they have a lot of operating income and, relatively speaking, little interest expense. To the extent that number is 1, it means they're using all their income to pay interest expense. To the extent that number is less than 1, it means they don't have enough income to cover their interest expense, which is usually a sign that your bonds are not very safe. There's no such rule that says how much debt a business should have. Most big companies keep a leverage ratio of about 50%, which means that about half of their assets are financed with debt and half of their assets are financed with equity. Depending upon the company, the industry you're in, what have you, those numbers can vary from there. Most companies do use some debt because it is very advantageous because of what we call leverage. And leverage is using borrowed money. And the reason why it's beneficial is interest payments are tax deductible for tax purposes, so you get to deduct the expense, and it's usually less costly than equity. So it's possible to increase your return on equity by borrowing money. And we talk about that in other classes, so I'm not going to spend a lot of time talking about it here. There are rules that require you to properly state your debt, and those rules have changed since Enron. And just realize in the case of Enron, one of the ways they committed fraud was by understating their debt, not putting it on their balance sheet, and they did that so they could maintain higher credit ratings. Much of that has been ruled to be illegal now, and they can throw those finance executives in jail if they go ahead and perform those types of fraudulent activities. There are some special types of liabilities that sometimes need to be reported on the balance sheet. Examples include leases. If you're going to lease a building for 30 years, There's some evidence that says that since you're leasing the building for 30 years and a building's useful life is probably 30 years, what you're probably trying to do is avoid putting that liability on your balance sheet. So will they make you do that? And the answer is yes. There are times where things like post-retirement benefits, okay, and deferred taxes are always on the balance sheet. But there are times where you do have to put special liabilities onto your balance sheet. That concludes Chapter 10. If you have any questions, please feel free to let me know. Thank you.